Hi everyone, welcome to my channel. I'm Doris and I'm here to share with you about my stock account and market update. Today my account lost $1,643. Also, today's CPI shows that inflation has cooled and US stocks closed higher for the fifth straight day. So first, let's take a look at my account. Right now the net assets of my account is $85,563.89. Today I lost, including the aftermarket, I lost $1,326, and that's a loss of 1.53%. In total, I have lost $15,617.57, and that's because today's XQQQ decreased for 1.52% to $46.72, and the DRV decreased 3.08% to $42.84. Let's take a look at the market today. All of the market indexes showed a positive growth, with Dow Jones 0.64% growth, Nasdaq 0.64%, S&P 500 0.34%. And looking at the industry heat map, the industries showed a overall good growth today, with semiconductors increasing 2.4% as Nvidia rose for more than 3% today, as well as oil and gas rose for 2.54%. On Thursday, investors welcomed the closely watched Consumer Price Index report for December. The Labor Department reported that consumer prices fell in December 2022, the biggest monthly drop since the outbreak began, indicating a moderate fall in U.S. inflation. The Consumer Price Index, which measures the cost of a basket of goods and services, fell 0.1% in December month-on-month, in line with the Dow Jones expectations. That was flat, with the largest month-on-month decline since April 2024, when much of the United States was under lockdown to fight the novel coronavirus. US CPI rose 6.5% in December from a year earlier, 6.5% expected, 7.1% last. Excluding food and energy crisis, the core CPI rose 5.7% in December year-on-year, compared with 5.7% expected and 6% last month. Separate data showed U.S. jobless claims last week was at 205,000 versus 215,000 expected, versus 204,000 last week. It's a decrease in jobless claims. Analysts said the CPI inflation data showed a modest cooling in the U.S. inflation in December, potentially strengthening the Fed's reason to slow the pace of rate hikes. The spread between the 2-year and 10-year yield curve widened 71.7 basis points after the CPI inflation data. The Fed's mouthpiece wrote that the CPI data showed inflation eased in December, which could lead the Fed to continue cutting its rate hikes to 25 basis points at its February 2nd meeting. Fed officials, open to a 25 or 50 basis point increase at their next meeting, said the latest data on the state of the economy would largely affect their decisions. But the slowing inflation data suggests officials will start to consider a modest 25 basis point. Economists said the CPI data showed us inflation continued to cool, and the Fed finally had room to cut interest rates. The modest rise in the U.S. core CPI month-to-month in December provided further evidence that price pressures are easing and provide rooms for the Fed to slow the pace of rate hikes next month. The core CPI was 0.3% month-on-month in December, which economists generally see as a better indicator of underlying inflation than overall inflation. The December quarterly CPI was negative 0.1% month-on-month, which economists believe Falling energy costs drove the first negative reading since May 2020, and the core CPI report will provide some room for the Fed to cut rates. U.S. short-term interest rate future rose, and traders now see the likelihood of a 25 basis point hike in February. Future markets, tied to the Fed's policy rates, suggests a roughly 100% chance for a 25 basis point rate hike in February. Philadelphia Fed President James Harker said after the CPI data, the Fed may raise interest rates a few more times in 2023. It is time for the Fed to adjust its future interest rates to 25 basis points. Harker said, "The era of oversized rate hikes is over. Core inflation could fall to 3.5% in 2023 and reach the Fed's 2% target in 2025. St. Louis Federal Reserve Bank president said the Fed should raise interest rates above 5% as soon as possible to ensure price pressures ease. He said the Fed's median December rate forecast showed officials favored a rate hike to 5.1% in 2023, appropriate to reach that level as soon as possible, and then maintain it. The Fed will have to keep interest rate high enough to lower inflation and keep it low." Mr. Bullard warned that the market could be too optimistic, that inflation would easily fall back to 2%. Core inflation has slowed, but it's slower than overall inflation. Most likely, the inflation figures will remain above 2%, so policy rates will need to remain higher for a longer time. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.